Hello, everybody, and welcome to the Catalyst Real Estate Market Update. We're about a minute away from noon, and we'll get started right on time. Thanks for joining us. Okay, it's 12 o'clock noon Central Standard Time, and I want to welcome everyone to the June 2024 Catalyst Funding Real Estate Market Update. This is where real estate investors like you stay up to date with the current real estate investment market. My name is Derek Engler, and I'm the Marketing Director for Catalyst Funding. And today, I want to introduce to you Catalyst Funding's industry experts, CEO Wade Comeaux.
Hello, everybody.
And we also have our Director of Lending, Jeff Johnson.
Hello.
And every month we have a special guest, and one of our favorites is with us this month. Please welcome Steve Davis, CEO with Total Wealth Academy.
Hi, everybody.
So for the last 30 years, Steve's helped teach and coach tens of thousands of people on how to use real estate to build wealth and passive income while focusing on maintaining a balanced life. And Catalyst Funding is a proud partner of Steve Davis and Total Wealth Academy. So before I turn it over to the experts, I want to remind you that we do have a drawing where one lucky listeners will receive half off their next hard money processing fee. So I'll be back at the end to announce our lucky winner. You do have to be present to win. And want to let you know before I turn it over to the experts that we usually have a Q&A if there's time at the end. So be sure as you're listening to interact with us and put your questions right there in the webinar, which this time is GoToMeeting, where you put your questions in. But starting next month, do want to let you know, special announcement, we'll be migrating over to Zoom and all of their upgraded webinar features. So be looking for the invite for next month's webinar. We'll be switching over to the Zoom platform. That being said, let me turn it over to the experts. Enjoy the show.
Thank you very much, Derek. And I want to say a few things about Steve and his team first. We really enjoy working with the group at Total Wealth Academy. I think the thing that makes them a little bit unique from some other mentorship organizations is the breadth of things that they teach. If you're newer and don't have a ton of money, they teach you how to wholesale properties to build up that worth. If you're very well capitalized and you're on the other end of the spectrum and really looking for passive, they offer that in a wide variety of categories, multifamily, commercial, public storage. And then if you're in the middle, where a lot of the people on this call are, where you have some capital, you're looking to invest, maybe a little single family, maybe some multifamily, kind of a wide variety of things. They also have you completely covered there, but they also really emphasize helping you in all parts of your life, your personal life, your relationships. So there's an outstanding organization. If you have not checked out Total Wealth Academy, we strongly encourage you to do it. They just opened up a new office in Dallas. We were there, Jeff and I were there on Tuesday. Beautiful location in Las Colinas. If you're in the Dallas area, you must check them out. Just a fantastic group overall with a beautiful new location for all of our Dallas listeners. So Steve, tell us a little bit about what's going on.
Well, first, thanks for the kind words. I truly appreciate it. And I think our partnership works because you guys think the same way we do. Our mission is to help people make more money with real estate and improve their quality of lifestyle. And you guys are doing the exact same thing, only a little more directly. Because when a person comes to you, they're in the middle of a deal. They're getting ready to change their lives. So I appreciate you guys' attitude and really respect your mission statement. But Dallas is rocking. I'm shocked at the number of single family deals that we're doing. There's a lot more of them than I really expected. I think, and I want to see the numbers because this is just anecdotal. It looks like things are coming back. I think the opportunities, there's more of them. I remember in 2021, we were making twice as many phone calls as we are now to find deals, maybe even 3 times as many phone calls to find a deal back then, as prices were going through the roof. But yeah, we are rocking. Our passive investing program is killing it. We're actually buying 6 commercial properties this month. Self-storage, 2 self-storage, 4 apartment complexes. So the members are really doing very, very well. And I'm loving all 3 of our main categories, which is apartments, self-storage, and senior living. Senior living still is producing a little bit higher rate of return. Then comes self-storage, then comes the apartments, but they're all very close. The internal rate of return that our members are getting is between 18 and 28% rate of return. And like I said, the senior living is getting the highest. But the record breaker was a self-storage deal we did about a year ago that did a 90% rate of return in 9 months because a REIT came in and bought it. So yeah, Dallas is rocking. Anybody that's interested, please come visit with us.
For sure. Yeah, beautiful, beautiful location there. Great speaking area, great presentation. You know, they always have outstanding presenters across a wide variety of educational areas. So you definitely want to sign up. Just so much content, not only live, but also their online content is pretty amazing as well. We met several people that were watching some of our videos before the presentation we did on Tuesday. So I know we have a few things on there as well. So just whenever you have access to live content, but also a lot of great online content, it can really help you speed up your growth and your journey.
Yeah. So Steve, I was talking to some of your folks in Dallas. The place is gorgeous. I think we almost lost one of our employees because he liked it so much. He's like, I'm just gonna stay here and see if they have any jobs. But the other thing I wanted to ask is, I was asking how most people sign up through Total Wealth, and it's a lot of referrals, but also they mentioned that you do a lot of media. So how do people get access to listening to you speak? I know you do podcasts and whatnot. What's the best way for people to learn about what you guys are all about?
I think the first stop is the website. There you can find out about our radio shows. We are on 7 days a week. These are hour-long radio shows where we dive deep into the concepts of building wealth with real estate. Then if somebody's interested in visiting the office, seeing exactly what we do, at totalwealthacademy.com, there's a free sample class. So step 1 is attend that free sample class. Step 2, start listening to our radio shows to keep yourself informed and motivated.
They can find that on like Spotify and whatnot, right? Like, correct? Like recorded podcasts and whatnot? Yeah. It's
on every platform that we can get a hold of.
Yeah, we tell our new LOs to listen to your stuff. It's a great educational, so they can learn the business. You do a great job of explaining, from the basics all the way to the higher level stuff. So really, really nice work.
Yep.
Well, thanks.
Well, let's dive in, gentlemen. Let's go to the next slide. Real quick disclaimer, just want to say we're just giving information today, our opinions, but every investor must do their own due diligence. Next slide. Real quick, I'm going to cover a couple quick things about Catalyst. If you do not know, we're passionate about being your one-stop shop for hard money, which is the money to purchase and repair distressed real estate, as well as long-term financing, mainly 2 categories: conventional refinances of those single-family 1 to 4 properties, excellent pricing, government subsidized, gives you a great chance to build wealth and cash flow, and also DSCR or no income doc loans. If you don't have documentable income, if you write things off, or if you're a full-time real estate investor, a fantastic way to build wealth through owning properties as a landlord. We also have 5-star customer service across all platforms, including Google and Facebook. And if you want any more information, please reach out to our team. We'll give that contact information at the end. Next slide. So, Steve, I know you're in Houston. Jeff and I are also living in Houston. Tell us a little bit about what you're seeing in the numbers here, as well as what your gut is from what you're seeing from your members?
Ooh, I hate that gut question because I'm such an optimist that I always see things getting better. Um, you can see minor changes in the actual number of sales, but look at the amount, it went from 3 million to 4.2 million. And in 23, didn't change too much from 23 to 24, but from an investor's point of view, these are mostly owner occupants, I'm sure. But from an investor's point of view, we're seeing more deals go through. And we're also seeing our members buying faster, meaning you go back a couple of years and the members were buying a house one every 6 months. Now I'm watching people buy 2 and 3 in a 3-month period. The other thing, and you can speak to this, Wade, I'm seeing a lot more 0 down or very low down payment deals. So that means those prices have dropped and we're getting better deals as well. So my gut instinct is this is going to continue at least a few more years until we see either a spike or a dip. I really think it's going to be a dip. And the sooner we have it, the better. There needs to be a correction from all the garbage that went on in 2021 and 20 parts of 22, where people were paying 50,000 above listing price, and it just skewed the market and made the numbers just wrong.
Yeah.
So we are focusing on going with the average sale price and doing all our numbers off of the average sale price from the last 3 to 6 months. And I think that we're down around 70% of ARV, which, that's the classic rule. You want to be down around 70% of ARV, but we're actually seeing it. So our purchase price, rehab, and closing costs is about 70% of ARV, which explains why there's more 0 down and low down payment deals.
Yeah, I think we are seeing that more further out. I mean, I think the deals in the major metros are on average, because we do quite a few deals, definitely are higher than that. But the deals where people are getting, on a flip 70% or on a rental closer to 75 and getting lower out of pocket, they're a little bit further in the ancillary market's a little bit further out. We see a lot of deals in Dallas that are up near the Oklahoma border and some of these counties that are a little bit further out. And what's great about that, if you think about it, is, a lot of these, like in Dallas, you've got McKinney, Plano, Frisco, and Houston, you've got Katy or the Woodlands, and you can commute from 30 minutes or 45 minutes outside of those places. You don't have to get to downtown to get an excellent job. And that means, in turn, if you are a landlord, you don't have to be in the suburbs to have a good opportunity. You could be a little bit further out and have people who could commute to one of the suburbs and have excellent jobs. We're seeing a lot of people, if they're getting those lower out of pockets, that's where we're seeing it. If you're going to be in a Katy, you're going to be in a Woodlands, you're going to be in a Kingwood or in Dallas, Frisco, Plano, McKinney, we aren't seeing them that low, but you also have higher appreciation in those markets. But we are seeing some very, very good deals. I think on average, our out of pocket, whenever rates were super low on a buy and hold deals, probably 45, 50K. Now it's probably 25K. And we actually have 2 that were on the market right now in San Antonio that are, Jeff, correct me if I'm wrong, around 15K. So if somebody's interested in that, definitely check it out with us. But to your point, the deals are better and the ROIs are better, even though the cash flow is not. I think people get too fixated on that cash flow number because it's easier to just, do easy math on. People were getting 450, 400 when rates were low. Now they're getting 200. But if you're out of pocket significantly less, that's a much better opportunity.
Yeah, and I think you were the one that shared this with me. You're not marrying that rate. If the rates drop, you can always refinance and increase your cash flow if the numbers work. But yeah, I agree with you. If I'm picking up you know, back then we pick up $20,000, $30,000 equity. Now we're picking up $40,000, $50,000 equity. I don't
Yeah.
care if I'm only making $200 or $300 a month compared to $400 or $500 before.
Yeah, for sure.
Yeah. Yeah, I mean, I look at Houston, and when I compare it to the other markets, I think it's probably the most stable. I mean, if you look at it, I know Austin had a massive run up and it's fallen back down. San Antonio is doing okay. I think it's struggling amongst the four is probably the weakest. But Houston, if you're just looking at, we're talking about markets, Houston is very solid, very liquid. It's seen steady growth, not massive run ups or massive rundowns. I look at that lease price. And, you know, we talk about it for a while now, but if you look at the lease price, it's gone from 1870 to 2340, right? What is that? That's almost $500. And
Wow.
so that's $500 in 5 years. So if you know, we're talking about the deals are better, less out of pocket. I think it's a couple of things. One, I think there are just less competition is the majority of it. So why is there less competition? One, rates are higher, so people are, like you said, foregoing cash flow. They're like, hey, if I can't make $400 or $500, I don't want to do the deal. So there's less people looking to buy. I think inflation is kind of squeezed the economy where less people can afford to be investors, to be honest with you. So if you are in the game and buying properties, if you get past the fact that you're going to cash flow $200 a month, over time, you're going to be happy because those values are going to go up, the rents are going to go up, mortgages will eventually get paid down, and rates at some point will drop. So you, like I said earlier, you can refinance. I think we did the math on it earlier. On a typical rental property, if rates drop 2%, it's like a $300 difference in your payment. So when you refinance, now you go from 150 to 450, that's a pretty significant difference, right? So I think, like you said, Steve, I don't know, we aren't seeing a lot of zeros. That's great. If you guys are finding zeros, that's awesome. But certainly way less than used to be out of pocket. And if you can handle the low cash flow, now is a great time to pick these things up.
I want to mention two quick things before we move to the next section. I'm always looking at months of inventory and days on market. In my opinion, those are the two biggest leading indicators of what's going to happen, 3-6 months down the road. A lot of these other numbers are where we're at today. And if you look at it, months of inventory from a normalized market pre-COVID, May 2019, 4.2 months of inventory, we're now at 4. Obviously way lower in the COVID era, but that was unprecedented, right? Absurdly low interest rates, tons of demand. Days on market, 53 pre-COVID, normalized market. During the height, it was 49, but look, 45. So both of the months of inventory and days on market numbers are better today than the normalized market. Now, why is that? It's not because rates are super low. It's because there's just a lack of inventory. So the market is still moving pretty well because the people are not giving up their 2 and 3% rates, their 4% rates. There's not a lot of inventory in the market. Most of the inventory, we'll show in a slide later on, is new construction, not so much of the properties that are, people are putting in existing properties. So I do think flippers are doing really well right now just because there's a lack of inventory. They're turning pretty quickly. So if you are a flipper, it does feel like it's a really good market for you as well because there's just not that much competition.
Yeah, I totally agree with that. That is,
all right, oh, go ahead. I'm sorry, Steve.
Yeah, that makes all the sense in the world.
Yep.
Yeah, I love those comments.
All right, let's look at Dallas. And this is where, as we mentioned earlier, Steve and the Total Wealth Academy team have a beautiful new office, really bringing a lot of great information to people up there. So the numbers here, if you look at the days on market, a little bit higher on months of inventory from pre-COVID, but the days on market are down. But the most amazing story probably is that average sales price increase since pre-COVID, 62%. Houston was what, 36, something like that?
Yeah.
That's an unbelievable difference.
Wow.
Even the median up 50%. Yeah, so to just give some context, Houston, it was up 37% average, median up 38, You can see Dallas 61 and 50. I'm going to look ahead to San Antonio up 35 and 31, and then Austin up 37% on that median. So Dallas is lapping the competition on appreciation over that pre-COVID era. Pretty amazing.
Yeah, I think we have to be careful because it could be part of it, and I'm sure part of it is that only the more affluent people are able to buy right now, and they buy more expensive homes. So that pushes the average sale price up and the median sale price up. Once the average person gets back in the game, once they get over the shock of the higher interest rates, and they get back in the game, I think we'll see that come down.
It'll definitely be interesting. Austin made that huge run up and had a correction. We haven't seen it in Dallas yet. I do think Dallas is a little bit of a unique story. Like there was so much California money and tech people coming in Austin, and that has tapered off a bit, I guess. Dallas is a little bit of a unique story because it's more white collar jobs moving in there. There's still an enormous pace there. It's really amazing that they haven't had any slowdown or pullback. I mean, even the year over year number is 5%, which is greater than Houston's 3.6. If you look at San Antonio, actually down year over year, 4.5% and 3.3%, and even Austin down 1.7%. And there was a time when Austin was down 15% year over year. Dallas just hasn't slowed down. So if I were going to say one market that may experience a little bit of a slowdown, it might logically be Dallas. But I keep saying that, and it just doesn't happen. So,
Yeah.
Well, I was looking at the rates. I mean, we have on here 2023, but I mean, rates really went up in 2022. Like they went from the prime rate went from 3.25 to 7.75 in that 1 year. So that, these 2023 stats and the 2024, like the rates are pretty similar. The last rate increase we had was July of last year. Like they haven't raised rates in a year. So like the comparison is really, maybe there's a little bit of a shock to the system, so people pull back. But like as we keep going, like the year over year comparisons are going to be more just like, hey, this is the market last year, this is the market this year. It doesn't really make much difference on the rate, if that makes sense. Like these are the rate's been stable for quite a while now at these numbers.
Yeah. Well, let's look at San Antonio next. So as we mentioned earlier, if you look at that average sales price of San Antonio down 4.5, median down 3.3. Then also, if you look at the months of inventory, the highest by far over that time frame, and compared to the other major metros, significantly higher, 4.9. The stable months of inventory, as I've heard for decades now, is about 6 months. So it's approaching stability. None of the other markets are close to that. So I do think that San Antonio is the softer of the markets at the moment, although I will also say their average price point relative to the other markets, including Houston, they're significantly less expensive on both the median and the average compared to Houston. And I do think there's a lot of upside there. In fact, we've shown some articles from national prognosticators saying that San Antonio is the #1 market of the country. I've seen a lot of people say that.
Wow.
Based on future appreciation. And I think it's because if you look at the amenities for a major city, the price point is one of the most attractive. And when we get to the affordability index at the end, you'll see like Dallas, San Antonio, Austin are much less affordable than San Antonio relative to income. I think we'll show that the average income in San Antonio is basically in line with Houston, just the homes are a lot cheaper. So.
Yeah, I was looking at the thing that I find interesting is the lease price. Like in Houston, like I was talking earlier, like they went up $500 over 5 years, and they went up $100 over the previous year. But both Dallas effectively flat, down like $25, but San Antonio is down as well. So like the leases aren't really following Houston's lead, right? Houston's increasing. While the leases here are pretty much flat for buy and hold.
Well, yeah, you mentioned Dallas being basically flat year over year, which is true. But if you look at it, they're up $700 from May of 2019, 700.
Yeah.
Where Houston's up 500.
Yeah,
And
they
if
have
you
like
had
a
rental
steeper
in Dallas,
runoff.
yeah, if you had a rental in Dallas and you were pretty happy making your $300 cash flow back in 2019, I know taxes have gone up a bit. Insurance isn't as bad in Dallas as it has gone up in Houston, but I'm sure taxes have gone up a bit. But you're getting a lot of that $700 increase, which is, that's one of the great things about real estate. You buy it and you're like, man, this 200 is a little bit tight. But then something happens like that where the average rent goes up $700, and as long as you're locked in on a 30-year note, which if you're going to do a deal with us, both the SER and conventional, that's what you're going to be locked in at. That is a gold mine.
Yeah, I've never had a tax increase kill me. Never.
Yeah. We were actually, it's funny, we had a borrower who, on a side note, backed out on a deal the other day, had $5,000 non-refundable put down, and actually a member of a mentorship organization, not yours, Steve, but person started, just to your point, looking at every potential negative, like, well, what if the taxes go up, or what if the insurance goes up, and taking a projected $250 monthly cash flow and somehow manipulated it in his mind to get down to about 100, right? But did not put in any of the what if scenarios for rents increasing, or all these other, like in real estate. And I think the moral of the story we talk about with our salespeople there, and I think it's important for everyone on the phone to think about, like there are bad things that can happen and there are good things that can happen, but those things are the same on every single property. So if you're looking at a property with $250 cash flow, you're going to say, what if taxes go up? What if insurance goes up? What if HOA goes up? It's going to be very difficult for you to ever find a deal that you're going to buy if you're going to kind of take those numbers down in every single property. So it's just part of the risk associated with any investment. But in real estate, those risks are exponentially less than in any other category. Like you're buying Enron stock, you don't know what the hell's going on over there, right?
Yeah.
At least you know this property's real. You walked it, like you know the repairs that need to be done. That's a very different scenario.
Is that I'm curious, Steve, is that a common talk you have with folks where they're ready to do their first deal and they just get to the point where they can't pull the trigger, where you need to kind of give them a gentle nudge to actually transact?
Yeah, there's many times where, this is a funny story. I had a family, they were about to buy a house. They came up with every excuse why they shouldn't buy the house. It was like 10 minutes of just fear after fear after fear after fear. And I went, if you don't buy this house, I will. They bought it because they knew if I had the confidence to do it, they should have the confidence to do it. And I meant it when I said it. It was a home run. And they were worried about the insurance going up and the taxes going up. But like you said, Wade, they didn't even mention that the rents would probably go up too.
Yeah.
But in my 34 years owning as many as 100 single family houses, I had taxes go up, I had insurance go up at the same time. And it never took me into a negative cash flow situation, ever, because I bought the properties right, because I had a good mentor. And it's just, if you got a good mentor, you know what you're doing, close the doggone deal based off the current insurance, the current taxes, and the current rents. If it works, it's probably still going to work, even if there are some future increases.
Yeah, it's funny. A couple of times I had a lot of remorse. One time I even got stuck with a home because a buyer backed out at the last minute, and I just went ahead and bought it and kept it in my portfolio. And candidly, that has been the most profitable property in my entire portfolio. It was a home in Sunnyside. And as you know, that market went way up. I bought the place for $15,000, and I was sweating bullets about it because it wasn't the best market then. And that home has just gone up in value exponentially. The cash flow is the biggest one I have on a monthly basis, and it's just funny. Sometimes the ones that scare you the most end up being the best, but rarely do you end up regretting it whenever you buy real estate.
Oh yeah, real estate is so forgiving. I've done some really dumb things and still ended up making money.
Yeah. Yeah. Well, let's deep dive Austin. So, Steve, I'm very interested. I know you don't have an office there, but I know you know the Texas market so well. And as we mentioned earlier, that was by far the biggest run up. And, it's definitely had the correction that you had said you thought you'd see. Now, it's not as big now. It's down 1.7% year over year. There was a point where it's down 15%. But if you look at the total active listings versus a normalized market, that's nearly double. The months of inventory from a normalized market for Austin is about double. It's almost approaching that 6 months of stability. So it's definitely a very different market from what you see in Dallas or in Houston. I mean, what's your gut there in Austin for real estate investors?
Well, I'm prejudiced because I love Austin. I think it's a cool place. I think that from my point of view, if you're a city person, that's the city to be in. It's got all the amenities. It's got the excitement of the politics. It's got the excitement of 6th Street. It's just a fun, great place to live. And I don't think these numbers are that far out of line. I don't see much more of a correction.
Agreed.
I think it's a good risk.
Yeah. I think to your point, and whenever you look at the affordability index a little bit later on, the average income in Austin is just really stunning compared to all these other major cities, the New Yorks of the world, Los Angeles, Miami, places that you think would have higher income. They do not. Austin has a higher average income than all those places by a pretty large margin. And the amenities, and you mentioned like a lot of the fun things to do, also just a beautiful city, right? Like you got the hill country, it's hilly, it's got beautiful water, like it's a very unique city. So I agree with you. The long-term predictions for Austin have to be high. It was just too much too fast, and there had to be correction.
And that was brought on by that hyper low inventory and that exuberance that everything was hunky-dory and going to go skyrocketing, and people made some mistakes.
Yep. In talking with a lot of agents there, they just had so many people from California that would walk in. They just sold their home for $5 million, and they're like, "What can I get here?" And they're like, "That's unbelievable! Like I'm getting 3 times the house. It's a better location. It's three times as large." Like they were just dumbfounded. So they didn't have to have appraisals, which appraisals are often the thing that kind of slows just massive appreciation from taking place. But if people are willing to pay cash, they can pay whatever hell number they want. There is no appraisal required. And that was really happening a lot. You got multiple bidders, and they're just like, I'm not going to lose this over $100,000 because I just made an extra 1.5 million that I think is just found money. It doesn't hurt me at all. I'm not going to lose this property. And I think that is balanced out. It's no longer there. And to your point, I think these are the right numbers instead of before they were just irrational.
Yeah, that story about California, I remember in the early 2010, 11, 12, there were Californians coming to me. And like you said, they just sold a house for 3 million, 4 million, 5 million. They would buy a better house with a pool, with a spa for 700,000. And then they passively invested the rest of it in apartments. They never worked again. They literally were able to come from California and retire themselves 10 years, 12 years early because of the prices of real estate in Texas.
Yeah, really, really amazing.
The only thing I'll say on this one is I think it's interesting that if you look at the 5-year history, Houston has officially surpassed Austin in appreciation. Wow. Like I would, and 2 years ago, I never thought that was even remotely possible, but it's corrected to a point where it's back in line with Houston numbers. They're basically the same. Houston hasn't beat by 1 point, but Dallas is the hype market right now. If you look at those 5-year numbers, it's not even close. It's like 51% over 38.
Yep. Let's go to this next slide. This is a great article that Jeff found from the people over at Bigger Pockets. Some very interesting information. Low inventory keeps renters renting. And it's a very interesting stat. The cost of buying a home is currently 25% more expensive than renting. Now, that tells you there's a lot of upside for rents if that's the case. because if my option, I only have two options right now. I can either rent or I can buy. And in order to buy, I have to pay 25% more. So that means there is a large amount of upside for landlords. So if you're making that decision, you're like, man, this $150 or $200 cash flow is not ideal for me. I think this is really telling that there is a tremendous amount of upside on rents.
Yeah. I have a couple of things. One, it is bigger pockets, but they're referencing the real estate analysts from Morgan Stanley. So they're pretty smart people. The main tenor is that if you own single family homes, there's going to be a robust market for people looking to rent said home. It's just too expensive to buy right now for the average person. And three, later in the article, they talk about, and you can, if you look at the numbers, I think one of the charts we have later, it talks about the amount of equity just sitting in American households. It said it makes all of the sense in the world if you have limited assets to pull cash out of your primary residence, even if you're sitting on a 3 or 4% rate, and deploy that cash to buy more properties. Over the long haul, that money will be, the return on it will be so much greater than if you just sit on your house with lots of equity, great rate, you feel safe, but you're not taking advantage of the opportunity that you have, which is tons of equity, pull it out. Like Steve said, he's seeing deals for $0 out of pocket, even if it's 20, 25 out of pocket. People are sitting on tons of equity. You pull out $100,000 or $200,000 cash, you're buying 4 to 10 houses with that money. And that is over a long enough timeline, that is going to create generational wealth if you have the foresight to just bite the bullet, get rid of your 3% rate, and use that money correctly.
I couldn't agree more, Jeff. It's crazy to have that dead equity sitting in your house when you could be building wealth with it. But what everybody's used to is they only make 7% in the stock market, so they do the math. If I get a 7% refinance and I put it in the stock market, that's break even. That's a waste of time. But I can't go into it for time's sake, but the average internal rate of return on a single family house is 30%. See, what people are doing is they're only looking at the cash flow, and that's 10, 12%. They're not including appreciation. They're not including principal paydown. When you add those three together, cash flow, appreciation, principal paydown, the rate of return is 30% plus. So if you've got a loan at 7.5% and you're making 30%, you're kicking butt.
Yeah.
Yeah. Well, you pull that money out. If you wanted to compare stock to real estate, say you get $200,000 out, you buy a house, and you're comparing that to real estate to stocks. The difference is you take that same amount of money and you don't need $200,000 to buy one house. You take $200,000 to buy 10 houses. And when you kind of build that up, it's not even close. It's a blowout, right? The leverage will allow you to just crush just regular stock returns.
Yeah, leverage is the key to wealth, and that's the missing piece in stock.
Yeah, this is a great article Jeff mentioned. You see the writer, but check it out. This Morgan Stanley real estate analyst, Laurel Durkee, appeared on CNBC. It's great to watch. Talks about how single family is the best category to be in at the moment for the reasons that we just described. Let's check out the next slide here. 15 largest gaining cities in America. Derek was kind enough to make this very simple for us and pointing to all the cities in the state of Texas. And it's 8 in Texas, 13 of 15 in the South. Pretty amazing, right?
I mean, Texas just dominates that list.
I don't know what Salina is. What is Salina? Is that like a suburb of some kind? And I gotta believe that's like a suburb of a major city, right?
I don't know. You guys chat, I'll pull it up.
Like I know Denton's up there, yeah. Fulshire, that's down here. So yeah, that's a lot. That is a lot of Texas.
North of McKinney.
There you go. The guy from Dallas knows. But But you know, the things that
Yeah,
things that are the common
it's
threads here.
north of Dallas.
Yeah.
The common threads here is that people are moving to the low tax, low income tax states, high economic growth states, less regulation states, and that's the common thread amongst all these states, right? Other than Washington D.C., which probably the only reason Washington D.C. has a lot of people moving there is because the government largesse has taken place and a lot of new jobs created by the $8 trillion we've spent over the past couple of years. So outside of that, it's all moving to, you know, to the areas where the economy is really good, jobs are good, and you can live at a reasonable price. So I think that's one of the big reasons we're so excited about Texas. There's a lot of things outside of these numbers that are good reasons to be in Texas. But if you have a lot of people consistently moving to your area where you are renting properties or you are flipping properties, that's a recipe for success. Next slide, please. Jeff, I know you're passionate about this slide. Tell us a little bit about this one.
So basically what it is it's a measure of housing shortage, like families that want a property relative to properties that are available. And so it's kind of what you were talking about earlier. The coasts, there's just a lot more folks that want houses relative to what's available. And then if you look, I guess that's Austin, that little blue dot down there in Texas. It's a little darker than the others, but for the most part, you know, you're able to, even though it's more expensive, you're still able to find properties in the South, the Midwest, and Texas. So that, I mean, that's a large chunk of why folks are moving. And then I think if you look at the next slide, I think it's the next one that talks about, yeah, regulation and affordability. Yeah, there we go. In 2022, housing was the least affordable and the housing shortage was most severe in markets with more land use restrictions. Like I know that in Texas, you know, God bless us, we're very low regulation relative to a lot of other parts of the country. And it shows, right? There's a lot of great opportunities. We don't have problems building. It's a big state. You know, you look at permits, they blow up in Houston and Dallas. And a lot of it has to do with regulations. And a lot of the states that have high regulations are struggling. They're on the previous slide, they're all in the blue, the dark blue, that is. So it kind of goes to show that there's obviously economics matter where people move, but also governance and how the states, you know, treat business or regulations to this effect really matters and on affordability and quality of life.
Yeah, and you would think that Californians would wake up. They're not showing this to the California people.
Yeah.
They don't know this is going on, but their government is destroying that one, you know, the most beautiful place, one of the most beautiful places on earth, California, and they are destroying it.
Yeah,
You
yes.
just can't build,
As far as
you can't build homes. You can't afford them, right? If you just have a complete lack of inventory, they just go up and up and up. So
Also, that's the beauty of the country, though, right? Like you can change your situation, move to a different state. You know, you have 50 little experiments running around.
yeah, vote with your feet, as they say.
Yeah.
All right, so this next slide is very interesting too. Single family permits year over year. Houston, number one, pretty strong year to date change. Dallas, number two, and look how much far they are above every other part of the country. That's really an amazing number. That's what we're talking about. A very pro real estate investor friendly state. That's a really big thing. And we showed a chart, might have been 6 months or so, Jeff, I think you'll probably remember it, where there were more permits to build in both Houston and Dallas than the entire state of California.
Oh yeah.
The entire state. And that is a much larger state in population. So
this is, in my opinion, this is one of the reasons why Texas is still affordable. It's because we have the ability to keep building, right? We have great economics, and if we had a limited supply of housing, I think our prices would go up significantly. But because we're able to keep building, and it's a builder-friendly type environment, you don't see the massive run-ups like you would in other places.
If we go to the next slide, this is very interesting. Multifamily permits. This is and Steve, you may have, you know, multifamily way better than Jeff and I do, but it's very interesting that Newark, New Jersey has double the multifamily permits of Dallas, and then, you know, man, that's 4.5x of Houston.
Is that just a
And
function of how many people are up there?
That's incredible. You know, but yeah, it's got to be, you know, New York City's 12 million, 13 million people now. So that's got to be, a lot of that's got to be in New York City. But when you look at Austin being at the bottom or towards the bottom, they're correcting because they gave too many permits in 22 and 23.
Mhm.
So they're slowing down. Houston is pretty consistent. Dallas, that's a little high for Dallas. That's a little shocking.
That's a big number. That's a
That's
lot
a
of,
big number.
yeah.
But you know, they're doing the same thing Austin did. If they overbuild, then what they'll do is they'll pull back on permits next year.
Yeah, for sure. All right, next slide. This is a chart that shows 1-unit structure starts versus 2-unit structure starts. National numbers here. And you can see the 2-unit tailing down and the 1-unit tailing up. And that article that we mentioned earlier was talking about the dynamics there, and that, you know, because of interest rates being where they are, a little bit tougher in the multifamily to do new construction. I think what Steve and his team are doing, you can correct me if I'm wrong, is that you're getting those deals. Like I recently invested in one where we're actually able to get into the deal at just a loan amount at what somebody did a couple of years ago. So you're getting, you know, we got that deal at like a 25% discount, which is pretty amazing. And so you're not necessarily, I'm assuming you guys aren't doing a lot of new construction deals. You're doing distressed, maybe small value play type deals in that multifamily space. Is that right, Steve?
Yeah, we do the bigger, as far as number of units, you know, 150 to as high as 500 units, but they are value plays. They are, you know, they need a lot of work, a lot of love and care. So I believe that right now we're buying property 30% below market, which you just described, 25% below. I
Yeah.
bet if you really looked at the numbers, it's 30% below, because I'm sure they didn't pay full price for it to begin with.
Exactly.
But to get out of those bridge loans with the fluctuating interest rates, they've got to move them. So we're picking up a lot of deals where people are in trouble with those adjustable rate mortgages, and they just got to get out. I'm in a building that sold for $7 million. This is just a $32 million building. It sold for $25 million, $7 million less. So you can imagine that's every bit of their equity. I bet you money they sold it at what they owed on it.
Yeah. All right. Steve has a hard stop because of his radio show. So I'm going to pick out a few slides that I think are extremely important. We're going to skip this next slide. We're going to go to this one, housing starts versus population. It's something we always talk about, but one of the reasons we are still really bullish on single family is just the complete lack of inventory. That's not going to be remedied overnight, simply not. If you look at this chart, it shows, you know, the growth in the population on this, I guess, yellow or brown line, total population, also up almost up to 360 million. But you look over time from the 50s till now, from 2010 till 2020, fewer homes were built than at any other time. Less homes than in the 50s, less homes than in the 60s,
Wow.
less homes than in the 70s, less homes than in the 80s. I mean, almost every decade. It's really shocking. And the population's double, more than double than what it was back then, right? So that is the reason that the inventory, and they're not going to catch up. It doesn't matter if we started building as many homes as we built in the 70s for the next decade. We still could not catch up.
Yeah, you're right. That is an interesting slide, and it's actually shocking. But boy, does it show the opportunity for new construction.
Sure, absolutely. Next slide. This one is just talking a little bit about the inflation is slowed, which could be good news for a reduction in rates. I mean, right now I'm hearing maybe one rate reduction before the election. That wouldn't be surprising to me. I think that's a reasonable prognostication. Here's the big thing. If you're trying to make decisions on when you're going to buy houses based on, a quarter point decrease in the interest rate on your mortgage, I think that that's a big mistake. I know that people like to hear about this. We get questions on it, but really judge the opportunities more by the opportunity itself than worrying about predicting rate changes in the market. I think a lot of people talk about dollar cost averaging in the stock market, like just always be buying stock. I think it's the same thing for real estate. If you're always buying real estate, that's the best move, not trying to time it perfectly, because none of us are that good, right? Nobody's that good to predict what interest rates are.
Yeah. Whether you're Jimmy Buffett or Warren Buffett, nobody knows what the stock
Yeah.
market will do or the real estate market. I borrowed that from the Wolf of Wall Street movie. Phenomenal movie if you want to understand the stock market.
Yeah, and the risks that are involved, right?
And the risks.
This next one is also on rate. I'd really like to get to a couple of this other ones. I'd love to get Steve's opinion on the next slide, which is the rental vacancy rate. So look at this, Steve. You look at the last time vacancies were this low, and it was in a period when rates were outrageous and people could just not afford to buy homes. If you think about it, look at the rental vacancy rates were super low from like 1970 to 1985. What's the other thing going on? Extremely high interest rates, right? Rates got up to 18% in the 80s, very difficult to buy a home. So everybody had to rent. Now rates are not that high, but high. And you look at that vacancy rate extremely low, which is great news for landlords. That helps you push up rents. You're not vacant as long. So one of the great things about a higher interest rate environment, a lot of investors are like, man, I don't know if I want to buy right now with rates being high. The good news is the vacancy rates are low and rents go up.
Yeah. So the income is there. Yeah, these people, everybody listening, you got to get past the fear that, because one of the things I teach my students is that the time will never be right. There's no right time. No matter what you think, I didn't start at the right time, Wade didn't start at the right time, Jeff didn't start at the right time. In fact, if I go back and look at when I did start, it was a horrible time to start, if you think of it that way. But what you've got, people are waiting for the planets to align, then I'll get started. Well, the planets are not going to align. It's not going to happen. Andrew Carnegie brought this up. He said, you have to start wherever you're at in whatever situation you're in, and better times will come. But if you don't start now, you probably never will, because there's never a good time to start. But when you show me this slide, good Lord, what else do you need? The income is there. People want your rental houses. They want your apartments. They're dying for them. You just need to put yourself in a position to help those people.
Yeah. Lowest vacancy rates since the 80s.
That's crazy.
Oh, yeah. Yeah.
This next slide's a very good one. And then I love to deep dive the affordability index at the end. It's always such great info there. So this one, talking a little bit about the market value of household real estate assets, rose from 44.9 trillion to 45.84. And that is like over the year, household real estate assets were up 7.75%. And you look at this and what this really speaks to me about is, sometimes people, we actually had a question come up at the TWA event Tuesday night, Steve, and a couple of the people asked the question, if I'm doing buy and hold, what do I do to protect myself from what happened in 2007, 2008, 2009? And I gave an answer, and I'll opine in a moment, but I'd really love to hear, what are you telling your members about what's different now and how to protect themselves from what happened to some people in that period right after the great financial crisis there?
Well, I never understood how people got in trouble, because if you've got a 30-year fixed mortgage Rents went up in 8, 9, 10, 11. How did they get in trouble? There's no trouble in 2007, 8, 9 if you got, again, that you got your 30-year mortgage, you got a fixed rate, a fixed payment, the rents didn't drop, more people were leasing. I just don't understand how people got in trouble. What you've got to make sure that you do is you got to buy the property right. You got to pick up equity when you're buying it. The name of the game is don't go pay full price and wait for it to go up in value. That's no better than the stock market. We're buying these things 20, 30, 40% below what they're worth. We're getting $200, $300, $400, $500 a month cash flow. I just don't see how people got in trouble. Anybody that tells me they got in trouble in 2007, 8, and 9, I'd have to analyze their business model, and I bet you I can pick 3 or 4 mistakes that they made, and it wasn't because of the market. It was because of those mistakes they made.
I would completely agree with you. I think they fell into 2 categories if they got burned. One, they were flippers who were in the very high ends of the market and betting on the come a little bit. What I mean by that is they had seen property prices go up 8%, 10%, 12% whenever they were buying their homes. And I've seen people do this during COVID. They were like, whenever I buy this home, it should go up another 12% by next year. By the time I sell it, I should get X. That's always a mistake, to bet on the come. You got to look at the numbers and where they are. Big mistake. Then secondarily, I really think it was exotic products. There were products back then where people could buy a home based on stated income. Like in the movie, what was the movie, The Big Short, where, you know, strippers were buying their 8th property because they stated their income was $12,000 a month. Like it was a crazy time. And then also there were a ton of ARM mortgages, right? And then there were negative amortization ARMs. In other words, your mortgage balance went up every month, but people were betting on the come. They said, why do I want to miss out? I can't afford this home, but if I hold on to it for 2 years, property prices are going to go up 20%. I'm going to make money. So I think it was, to your point, mistakes. I think if you were a principled investor in that time, especially buy and hold, you were going to be absolutely fine. If you were a flipper, you could have got stuck a little bit, but if you bought at 70 or 75% and the market came down 10, you're not going to crush it, but you're not going to lose money. But if you bet that it was going to go up 10% the next year, that's where you got hurt.
Yeah, I think that's well put, Wade.
The quality of borrowers was just not nearly what it is today. It's not even close.
Yeah, and that's another thing. Like the quality of borrowers, average FICO score is higher. The products are a lot more conservative. There's no neg am mortgages. I think the ARMs are down to like under 2.5% of new originations. Back then, they were like in the 60, 65% ARMs. Just a very, very different mortgage market. So we got 3 minutes, Steve. Jeff and I may go on a few more minutes to cover some questions, but I always love to get your opinion on this affordability index before we wrap up, because I know you got to move on to your radio show. So if we can go to the next slide, the affordability index. You know, this is actually the lack of affordability index. If you look at those at the top, can we go to the next slide, please? Thank you.
Yep.
Yeah, so this is just like, you know, Los Angeles, Miami, New York, the 3 least affordable. So tell us what you see here, Steve.
I almost want to get political and go, I see Democrats and Republicans. You know, it's like,
Tonight's the night.
look at those states.
Yeah.
They're just overpriced, something for nothing people that, you know, that it just, man, that's crazy.
Isn't it?
Look at Oakland, $719,000. And I don't want to diss any city, but that's just crazy. San Francisco, 1.3 million bucks, $6,000 a month. Yeah, this is just more indication that Texas is balanced. It's the safest place to invest, in my opinion. There are other places that are pretty close: Phoenix, Arizona, Oklahoma. There's some other states, but Lord of mercy, if you're in Texas and you're not buying real estate, there's got to be some fear in your brain that's holding you back. and that fear isn't real. I mean, this is the best place. It's just crazy.
Yeah. You know, one thing that jumps out at me before you move on is look at that Austin income increase. Household income back in 2019, 63,000 on average. Look over at 2024, 89,000. Man, that is almost a 50% increase. That's that tech movement. There are so many California and West Coast based tech companies that moved in. And so there's still some upside there for Austin prices to go up some more. But I mean, Austin went up quite a bit in that time frame, 395 to what's showing now 598 on this. This doesn't align perfectly with the local NMLS data, but you know, as far as the average home price, but very interesting data there. But whenever you think about the amenities of those big 5 cities up top, you know, the Los Angeles, Miami, Irvine, New York, and then the amenities of the Dallas, Houston, Austin, they're very closely aligned amenities. That's why we really believe there's a lot of upside in home price appreciation. Dallas may have a little correction, sure, but if you're buying and holding, maybe it comes down 5% year over year. In the long run, it's going to go way up. I think Austin, Houston, and San Antonio have a ton of upside from where they are because they haven't gone up as much. But to your point, Steve, those markets are fantastic. And you get into the ancillary markets, it's even more affordable. Just think about like a Corpus Christi, you know, 35% share of income for a payment. But actually, San Antonio's right there too. That's what I was talking about earlier. Austin, 52%, Dallas, 51%, Houston, 46%. You come down to San Antonio, only 36% of the income is required for an estimated mortgage payment. That's amazing.
Yeah, it's just more proof that I just got lucky moving to Texas, you know.
Well, maybe all the people that got lucky moving here had a big impact in the state as well. I think, you know, the things that you do to help people change communities and help people build wealth, all that stuff makes a difference in building a better community. So great job.
Thank you.
Well, we know you have the radio show coming up. Anything left that you want to tell people about Total Wealth? Anything they need to be aware of that's coming up before we wrap up?
I think what I'd like to finish with is if there's someone viewing and they're thinking about investing, but they can't get themselves to pull the trigger, get a mentor. It doesn't have to be me, but find somebody you trust that's done a lot of real estate and can tell you, hey, take action, get the job done, because these people wouldn't be on this webinar if they weren't serious. But there may be some series of fears that they have that's keeping them from taking action. Join a club, get a mentor, get around people who are doing it, and that will boost your courage. And then go see Wade and Jeff and get those loans taken care of and buy that real estate.
Yeah.
Perfect way to end it.
That's great. Well, Steve, we know you got your radio show. If anybody else is wanting to hop on the radio show, where can they find your radio show today, Steve?
Today it's AM 700 in Houston, Texas. It's KSDV. It's KSDV. Just Google KSDV and you can listen to it right there at the website. It's from 1 to 2, but I do believe that they've already begun a repeat. So if you're going to do question and answer, I'll stay.
Okay. Derek, what questions do we have today? And then we can also announce our winner.
Absolutely. So we've got the winner of the drawing. I'll get that at the end. And then we have 2 quick questions here. So basically the first question, you'll talked a lot about the cash out refinance. Someone says, how long does that process take? Where can I get more information?
So cash out refi on just a traditional traditional owner occupied refi, that's going to take you 3 weeks to a month tops. Just a regular conventional loan. We do have a DSCR. If you have an investment property, we can look at a DSCR cash out as well. Those are still very attractive rates. That may take a little bit longer, but not much. Honestly, we're talking 3 weeks to a month. So if you have equity in your house, you can be buying properties within 30 days from now.
I want to add one thing to that. We recently made a move on our long-term loans. We partnered with NRL, Nation's Reliable Lending Mortgage, and we actually have the ability to internally underwrite most of the DSCR loans, and that has totally changed the game for us. Before, most of our competitors, and we were brokering all those loans, and it'd be about 2 weeks from the time we had a completed package, maybe 2 to 3 weeks from the time we send in a completed package to close. We just closed a DSCR loan the other day, and right at 3 weeks. So the time, that is just amazing because it's an internally underwritten product now. So time is of the essence on a lot of these DSCR loans because you want to lock them as well. We also have the ability to lock those because we're not brokering them. So very excited about the new DSCR product that we have. All right, what's the next question, Derek?
Sure thing. Second question is, where are some of the best places to find deals on distressed properties?
Steve, why don't you tell them a little bit about how you help your members with that? How do you guys go about it?
Yeah. I find them all over the place. I really do. I used to think, it would just be in the $250,000 to $350,000 price range. But when I started flipping, I was finding distressed properties in the $500,000 neighborhoods, the $1 million neighborhoods. It's amazing. A person can live in $1 million home and completely destroy it. Just neglect it, beat it up, and then move on. And so I don't think there's any one specific place. You need to look at all neighborhoods. But to Wade's point from earlier, I'm telling all my students, especially if they're beginners, to stay in the 500,000 or below neighborhoods, because that way, if there's a correction, you can lease that thing out for positive cash flow.
Yep.
And then once you've gotten experience, then look at the higher priced homes. But be prepared to discount that thing and get rid of it if there's a correction. So look everywhere.
That's a great point. When you're first getting started and maybe you don't have your valuations completely dialed in or your repair budgets completely dialed in, you don't have your team built out, you don't have all your contractors really dialed in, the price point, people you completely trust, be in those lower ranges because it's a lot more forgiving. You don't have to have that elite level of finish that you're going to need to have on $1 million home. And then to Steve's point, if you have multiple exit strategies when you're first getting started, through no fault of your own, you may end up with a little bit more of a rent level finish, and you can transition that to a buy and hold, if you have to. So I think it's a very forgiving price point below 500. Anything else, Derek?
Well, we do have a winner to announce for today's drawing. Receiving half off his next hard money processing fee is Tim Dutton. Tim Dutton is the winner of today's drawing.
There you go, Tim.
Good job, Tim.
We'll be back on
It's your lucky
next
day.
month.
Maybe go buy a lotto ticket as well.
I got a question. Wade, if I find a distressed property, it's worth 300, I can buy it for 150, it needs 50 in rehab. How fast can you close a hard money loan on that?
That's a great question. So our typical turn time to close is about 7 days. There's two critical things, two pieces of advice that are super important. That's 7 days from the time we get a contract and a repair budget. We do have to order an appraisal that protects you and also protects us and our investors. We cannot order that until we have that repair budget and the contract. So a lot of times investors, when they're new, they think, hey, Wade, I told you I want to get the ball rolling. So the ball's rolling. The appraisal is the one thing that slows us down. Now, in some special circumstances, we can close even faster than that. We've closed deals in as little as 2 or 3 days. We have appraisers who are very loyal to us in the major metros, and we can move faster. But I would say, to be safe, you never want to write a contract for less than that 7 day period.
So everybody listening, you could literally be in a deal in 7 days from now.
Yeah, absolutely. And I tell you, if you join Steve and their team, they have an outstanding group of agents. They're constantly putting deals out. So if you want to get in the game, one, get educated first, get pre-approved, but you can be doing deals in an incredibly short period of time if you invest in your education. Steve's going to tell you, don't go buy one until you watch a lot of videos, attend some classes. But if you invest a lot of time and energy, that does not take months or years. It can really happen quickly. All right, everybody. Steve, as always, really appreciate it. Very happy about you and your team in Dallas doing great stuff up there. Thanks for joining us.
Thank you.
All right.
Steve.
Have a great one. Thanks, Jeff. Thanks, Derek.
Bye.
Take care, everybody.
See you next month.